For those who like stocks, it doesn't get more exciting than this. We're in the middle of one of the biggest weeks for the markets. Janet Yellen's last Fed meeting wraps up in just a few hours. Geez, we have Facebook. Is that ever going to quit? Coming in hot in the earnings. Tomorrow we'll hear about the 3 A's, Alphabet, Amazon, and Apple. And in this market, you have to stay focused and examine everything, all angles, fundamentals, technicals, whatever you can use to get it right. For the next hour, we're going to do just that. And that's why I'm so excited to welcome Philadelphia's own, not that I'm not, Marc Chaikin, founder and CEO of Chaikin Analytics. He's the man behind a host of unique stock market indicators, including Chaikin Money Flow, which we use every Tuesday night on Mad Money. Before we get started on the specifics, I think it's important to point out some things you need to know about Marc. Marc wasn't born yesterday. Marc is not an algo. Marc is someone who knows more and understands what to look at, and it's pure joy. And before we get started, Marc, I've just said what I know about Chaikin, which is that I'm all in you. But you've got a great service, and it's a service that I've used. It's a service I don't like to go against. It's the way I always look at it. Don't go against this guy. I want you to talk about him.
So Jim, before I founded Chaikin Analytics in 2010, I was a market technician for 35 years.
Of which we used you, my hedge fund.
Yeah, but I always knew that fundamentals drove the market. Right. So when I came out of retirement, I built something called the Chaikin Power Gauge rating. I believe you got to look at fundamentals and technicals. Right. So the Chaikin Power Gauge rating is basically a 20-factor model that I developed based on 30 years of working with institutional investors like yourself. This model, which is up on the screen now, works because it's based on how Wall Street works. Right. It was not developed by newly minted PhDs. I like to use the phrase throwing digital spaghetti on the wall to see what sticks.
Makes a lot of sense.
And this is what got us in trouble in 2008 and in 1998. This model looks at the factors that successful buy-side managers look at every day. So it's been in the public market for 8 years, and it's the way we're able to look at 5,000 U.S. equities and ADRs.
Which is fantastic. I don't know if people understand the breadth of what you're bringing. I also don't understand. I think that people understand this is not the fundamentals like, oh, okay, the infrastructure stocks are strong. No, it is much more granular. It uses things like cash flow, things that people want to focus on, like multi-factor. I mentioned cash flow just because it's like going in more rigorous ways, but earnings, but all involving, to me, universality. Because as a fund manager, I always wanted to know apples versus, tell me why I should buy Caterpillar versus Celgene. You come in with my office and you have two different ones. Well, here's very specifics about why this one's better than that. And look at this breakout level. Look at what's happening here. So, I just think that we ought to just spend a second on the power gauge because when a stock, as we had that great seminar with you, when a stock's in sell mode, I'm not interested. In neutral, I may be getting interested unless it's coming from buy. And then you've got buys that are, I don't want to say I ever do anything blindly, because as you told me, hey, it's on you, Jim, when we're doing the hedge fund. But the fact is, you flag things. So just talk about the notion of what you're flagging right now.
So we're looking at basically 4 primary factors: value, growth, technicals, which are only 15% of the model, and sentiment. And sentiment might be our secret sauce. Very few quantitative models look at insider buying.
Right.
Which is really important, particularly in the small cap space.
Remember that used to be important? What happened? Why did that go out of style, even though you and I know that you only buy because it's going higher?
Because there's too much data out there. And that's one of the problems we solve. There's information overload. So people are looking at what they cherry pick to look at.
Right.
We also look at short sellers. My theory is the short sellers are the smartest people on Wall Street. They've often said about Jim Chanos, he's rarely wrong, but he's often early. Right. So when there's a big short position, that tends to have a little bearish effect on the model.
Okay.
But as in the case of Lam Research, as it went from 40 to 220, the short interest was high the whole way. So things can override that. Our model was bullish, as we'll talk about later on Lam Research. So these are some, and we look at industry group strength. That's something you focus on Mad Money all the time. It's a tailwind. When the sector, when the industry group is strong, that gives you a tailwind. So I call this an eclectic model. It's a reality-based model.
Right.
It knows what successful buy-side managers look at. They have different time horizons, they have different styles, so it can like a value stock as well as it can like a growth stock.
The reason I wanted you to point this out is that we have a lot of regular people watching, okay? Now, when I was hedge fund manager, I focused on everything you said, but regular people can use this. It's not confusing, and it is not mumbo jumbo. And it's real life, but it is exactly what we want to hear. So let's go into some things that are pertinent today, because I know your fundamental analysis is going to play into today, but play into this period of time. That's right. Federal Reserve today, final meeting. You know, one of my writing colleagues, Matt Horween, was saying, you know what, we're really set up, given how hot the numbers are, that she should do a surprise. But the fact is, the issue, she can't do that. That would be out of form. But the question is 3 or 4 hikes. And the reason I ask that is because we happen to like the financials for action alerts. It's all based on more hikes than fewer. So you've got the floor.
I think 3 hikes is what we're going to see, and that's based on what the Fed has already told us. 4 hikes, if it takes us beyond 3% on the 10-year Treasury, I think the market's going to get nervous. You just saw that on Monday, Tuesday.
Yes, that was what that was about.
Big the market likes slow and steady and no surprises. A big 14 basis point spike in the 10-year Treasury is part of what gets the market nervous. I know people try and find reasons why the market moves, and rarely is it germane, but I do think since the decline started in Asia at midnight,
yes,
they saw the jump in the Treasury rate and they got nervous.
Right, that was, I remember watching the futures overnight and saying, what's the correlative here? Is it oil? Is it dollar? No, it was an
interest rates.
10-year. So given that, we've been adamant that we want to be bigger in Jpmorgan. We're looking at some regional banks. We like the brokers if we can find the right ones. You are involved with one that frankly I haven't looked at, Raymond James.
And the reason is there's very little analyst coverage. There are only 4 analysts that cover Raymond James. So there's an opportunity.
Already I like this.
There's some hidden opportunity.
Yes.
So Raymond James used to be known as a regional brokerage firm, but they also are one of the 3 largest independent broker dealers, along with Ameriprise and LPL. What's happening, and we see this because we're in advisor meetings all the time with our advisor clients, advisors are leaving the big banks like Morgan Stanley, Wells Fargo, and Merrill Lynch, and they're going over to Raymond James and some of the other independents. But Raymond James has seen their AUM more than double in the last 12 months, so that's really important.
This is a key metric for when you're trying to figure out brokers, right? Assets under management, very important.
And the reason they're doing it comfortably is that the smaller brokers have caught up in the technology race. So an advisor needs technology to support his business.
Right.
He also needs some product, but he doesn't want too much product. You know that
no overload.
Firms can push product on the advisors.
Right, and that's the sure way these days with all the transparency to ruin your business.
So I see an acceleration in earnings. Raymond James is going to earn $689 in 2018, up from $523. That's a 30% increase. Previous year up 18%. I love to see acceleration in earnings.
Sure.
So what
I'm writing it down because I'm looking all the time for what I would call a little bit more off the beaten path, because everyone's focused on Morgan Stanley. I have no value add there.
So what I'm looking for in general in the stocks we're going to be talking about that the Power Gauge likes is stocks that can go up 20 to 25% in a market that I think is going to go up 10% in terms of the S&P 500. I want stocks that can go up double the market, but without high beta. So we're looking at stocks with bullish Power Gauge ratings, strong technicals, and a rationale. I don't invest blindly either. I always like to know the rationale. You know, it has to pass the smell test. And
but
so,
what I think matters is that's a great idea, but you and I are seeing eye to eye on another stock, and it's really important to pronounce. And by the way, just so people know at home, I'm taking down Raymond James furiously because I'm always looking for action alert names, and I'm tired of just having one big one, but I've got to talk about the big one because you and I agree, which is Jpmorgan.
I made Jpmorgan my bullish stock of the week last week in my weekly market letter for 3 reasons. The economy is strong. We saw that this morning.
And it's correlative.
Chicago Purchasing Managers Index way ahead of expectations. The ADP jobs report strong.
Smoking hot.
So what does that translate to? Loan growth.
Right.
In both their private banking and commercial banking
Acceleration
area.
of loan growth from a fourth quarter that wasn't as strong as I would have liked.
What's the second thread in the company? Capital markets. It's going to be a lot of M&A activity. Some of this money that's going to be repatriated from overseas is going to trigger M&A transactions, and then the third aspect of their business, the advisory asset management business. A rising stock market automatically increases your AUM, but they're bringing in AUM.
So all right, so I need your help on this. We have a discipline, and I'm sure you remember these kinds of disciplines that sometimes they hold you back, many times they save you. We don't like to pay above our basis, but Mark, the stock has gotten away, and we didn't get our full position in. And we've been telling investors who take our product that, are members of our club, we like it, like it, like it. At what point, if you are our team, would you break discipline and say, you know what, this one is leaving the station and you got to get in, or is the train analogy bad and you just have to be patient?
You have to be patient. It's frustrating to watch a stock keep going up, but let's take a look at the bigger picture. 878 this year versus 687. And the early projections for 19, 957.
Well, that's a growth stock with a multiple that acts like a value.
So put a 15 multiple on $10 in earnings, and you get a $150 price target. And that 15 multiple is right in the sweet spot. The low average 12.5 PE, high average 18 over the last 5 years. So that, again, that's where I like to add a little bit of value.
Given that parameter, would you still want to wait for downdraft? There's just no reason to just come in and buy, right? That's just not our style.
But look what it did yesterday. It barely pulled back with the market getting killed.
See, to me, that was a sign. That was a sign that you cannot wait for this stock to come in big. If you get a little bit of a discount, you can pull the trigger.
So I like to use a very simplistic phrase: 1.5 to 3 day pullback, 1.5 to 3%. In a very strong stock, that's all you're going to get. If it pulls back to the 21-day average, that's just a bonus. Right. I don't know that JPM will. Eventually, we're going to get a 5 to 10% market correction this year. I've been saying that since December. This year is going to be a little different, more volatility. And by the way, volatility helps their trading operation. Now, Jpmorgan is not as trading oriented as, say, a Goldman Sachs.
Well, let's go there, because if you just listen to what you just said on that volatility, I want to buy Goldman. I happen to like Goldman, worked at Goldman. You're not as high on Goldman.
I'm not, because the institutions are not as high on it. The Chaikin Money Flow has been much choppier. Chaikin Money Flow.
Now, go into that again so people understand. This is not something which is concurrent. It's predictive. And that's what
it has been predictive for over 35 years. That's what attracted you to our product when you were running the hedge fund in the 90s. So Chaikin Money Flow measures accumulation and distribution. Now, a priori, that's the institutions. That's the big money. These are the elephants. So we look back over 21 days, average it, and there's a really simplistic way to look at it. I won't get into the details, but it's dependent on where a stock closes in its range for the day. And I've been on Wall Street 50 years. Not much has changed. Stocks that are strong, where everybody agrees on the fundamentals, sellers get satisfied early in the day. At the end of the day, there's residual buying. The PM comes into the trading room saying,
Did you finish that position?
And he says no, and he says, oh, heck, buy it at the market, right?
Get it in. I want it on my sheets by tomorrow morning.
Exactly. So Goldman has choppy money flow. There's one other thing with Goldman that bothers me. You're right in that the weak dollar and volatility help their commodities business.
That FIC business has been so
the
bad.
Fixed income. But there's one thing that just surfaced yesterday that I've been looking at. Asset management businesses become much more important to Goldman. Where are they getting the fees? Mutual funds, very high fees, and private, very wealthy private. Minimum accounts, $50 million. Yesterday, there was an article in Investment News that they had net outflows of $9 billion in their mutual funds. Where is the money going? They've created ETFs in this race for a bottom on fees. They're charging as little as 9 and 12 basis points for their ETFs.
It's going to ruin their gross margins. We care about the gross margins tremendously.
Yeah. So that's an area that hasn't been factored in.
Well, that's great info. I often look at these things and say to myself, all right, I don't have to like them all. I mean, I just have to like Jpmorgan. And if I'm looking for a name that might be able to vastly exceed the market, I take a look at Ray J. The one thing you don't ever want to do is say, I got to have a line on everything. Oh, geez, Goldman's no good. I'm going to sell my Jpmorgan. It doesn't work like that. There's good and bad.
Or go back to the well on a stock that you like just because you work there and you've made money with it in the past.
Right, but I think look, you've got new information. We have to adjust with new information. I'm going to check that after this because look at what that would do to the gross margins, because it would be one of the reasons why the stock turned was people believe that the gross margins are going higher after that, and that was 12th quarter. But it may not be the case.
Well, when you go from 95 basis points in a mutual fund to 12 basis points in an ETF, do the
No.
math, it's
No.
not that difficult. Now, it's not going to destroy their business, but that actually has been the fastest growing segment of their business.
Okay.
And here's another reason. The underwritings from Silicon Valley and China, Goldman's been a major player.
Right.
What happens?
China was, all those underwritings were terrible and they've stopped.
They bring in the executives and they get that money in their asset management division.
Okay.
And they've been charging very rich fees. There's now a pressure. I call it the Amazon effect. Everybody wants a bargain, even
Right.
in asset management. So we'll see where Goldman goes. I'm not saying it won't go higher. I would just rather buy JPM or Raymond
I'm
James.
in agreement. Now, here's something.